This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, July 15, 2026, and this is the London session. Now, let's get into it. Fear and greed has collapsed to 14 out of 100. We are deep in the red zone of investor caution, and that extreme caution is reshaping the London session right now. As we look at the European Open, the interplay between geopolitical shockwaves and central bank rhetoric is defining every pip. Let's get into the data.
Welcome back to the London session of ShadowQuant Forex Edition. I am Apex, your lead orchestrator. We are operating in a market defined by a singular, overwhelming directive: capital preservation. The director's brief paints a clear picture. A geopolitical shock involving US-Iran tensions is driving safe haven flows, while the ECB is signaling readiness for immediate monetary action. This creates a structural paradox. On one side, you have a risk-off regime that favors the US dollar and gold. On the other, you have ECB policymakers explicitly stating they are ready to tighten policy if needed. My job today is to synthesize these competing forces. Pulse, let's start with you. How does this central bank divergence actually play out in the current macro environment?
It plays out as a standoff. The Federal Reserve is effectively on hold, maintaining its rate at 3.62%. And while there is a headline about cooler U.S. inflation giving markets a breather, the reality on the ground is stickier. Core PCE is sitting at 3.41% and CPI at 3.46%. Both are well above the 2% target. Meanwhile, ECB policymaker Kocher didn't mince words. He said they are ready to take monetary policy action at any time if needed. And Stornaras directly linked the US-Iran conflict to renewed inflation and growth worries. So, you have the Fed doing nothing, and the ECB threatening to act. That divergence is forcing capital away from rate-sensitive assets and into hard stores of value. The 10-year, 2-year yield curve is flattened at just plus 0.4 percentage points, which screams recessionary anxiety. We aren't seeing a soft landing narrative here. We are seeing a hard pivot toward defense. So the market is pricing in ECB aggression because the data isn't cooling fast enough. But let's look at the actual price action. Grid, where are we standing technically? We have euro-dollar at 1.1438, cable at 1.3404, and dollar-yen at 162.14. Are we at a breakout or a breakdown?
We are nowhere near a breakout. We are in a tight consolidation phase, essentially suffocated by the very fear narrative Pulse just described. Let's look at euro-dollar. It is trading at 1.14381, which is smack in the middle of its 5-day range of 1.13776 to 1.14624. The price rejected the daily high back on July 14th at 1.14624, and since then, it has been drifting downward or sideways. There is no momentum here. Similarly, dollar-yen is at 162.143, pressing against the upper bound of its 5-day high of 162.488. We are running out of room to breathe, and let's not ignore gold. Gold pulled back from an intraday high of 4,062.25 to sit at 4,032.55. That is a drop of over 100 points from the 5-day peak of 4,134.98. The rejection at 4,062.25 was clear. The market tried to push higher on geopolitical fears and sellers stepped in aggressively. We are looking at mean reversion. Unless we see a daily close below 1.13776 for the euro or below 161.2825 for the yen, the structure remains a range-bound squeeze.
And that range-bound squeeze is hiding a massive positional imbalance. If you look at the COT data, you see speculative capital is screaming in one direction, but the spot price is refusing to budge. The most glaring anomaly is yen. Leveraged funds have added 91,779 contracts week over week. That is a massive surge in yen longs. Yet, dollar-yen is still trading at 162.143. Why? Because there is still a lot of short interest to absorb. But here is the kicker. Pound leveraged funds have reduced exposure by 18,447 contracts to become net short 468. They are betting against sterling, and DXY, The net long position is plus 4,438. We have smart money hedging for a yen appreciation and dollar strength simultaneously, while the spot market is grinding along near highs. It is a fragile equilibrium. The lack of selling pressure in dollar-yen is masking a rapidly accumulating wall of long yen contracts. Once that wall hits the 162.488 resistance, the cost of carrying those longs becomes unsustainable.
I agree with CIPHER that it is fragile, but I think you are both underestimating the speed at which this can unravel. Look at the VIX. It is at 17.16. That is in the upper quartile of its 5-day range, which spans from 14.96 to 18.91. We are sitting just 1.75 points away from the ceiling of that comfort zone. When the fear and greed index is at 14 out of 100, you are dealing with extreme contrarian exhaustion. Extreme fear usually precedes either a violent mean reversion or a disorderly break. Right now, everyone is clustered on the long side of yen. If the VIX ticks toward that 18.91 level, you won't get a slow grind down from 162.143 to 161.28. You will get a liquidity void. The technical resistance at 162.488 will be breached by forced covering, not fundamentals. Chart patterns become irrelevant when volatility expands that quickly. And look at gold, trading at 4,032.55, right in the middle of a wide range. Institutions are hedging against both upside geopolitical shocks and downside deflationary pressures. The noise-to-signal ratio is off the charts. This isn't stability. It's a loaded gun waiting for a trigger.
So the risk is that this consolidation is just a calm before a storm, with positioning becoming dangerously crowded. Let's dig deeper into the specific pairs. First, let's talk euro-dollar. It's at 1.1438, up 0.12%. Pulse, you mentioned ECB hawkishness. Does that provide a floor for the euro here?
It provides a theoretical floor, but the market is skeptical. Kocher said they are ready to act at any time. That is a threat, not a promise. The market knows that inflation is still sticky. However, the broader risk-off environment is capping any upside. Even with ECB hawks talking tough, the euro is struggling to gain traction because global capital is fleeing to the dollar. The euro is caught in the middle. If the ECB follows through with tightening, the yield differential might improve. But right now, the fear narrative is stronger. We saw the VIX rise to 17.16. That energy is going into U.S. Treasuries and the greenback, not the euro. So while the ECB wants to hike, the market wants to hide.
And technically, the chart confirms that skepticism. As I noted, 1.14381 is the midpoint of the 1.13776 to 1.14624 range. The fact that it couldn't hold 1.14624 yesterday tells me that every bounce is met with institutional selling. There is no follow-through. If we lose the 1.14 handle, which is roughly the lower third of the range, we are looking at a test of 1.13776. And honestly, if the ECB decision on Thursday doesn't produce more than just verbal threats, I wouldn't be surprised to see a break below 1.13776. The structure is weak. It is consolidating, yes, but it is consolidating downwards into support.
Which brings us back to positioning. The net long position in euro is plus 1,696 contracts. That is an increase, sure, but compared to the 18,447 contract exodus from pound, it is negligible. The flow data shows that traders are using euro as a passive hedge, not an active buy. They are holding it while shorting sterling. You have a net long tag, but the velocity of that capital is zero. It's dead weight. Until you see a rotation of flows from dollar/euro into pound or Aussie, the euro will remain stuck in this median. The COT data doesn't scream buy euro. It whispers wait and see.
Okay, let's pivot to cable. It's at 1.3404, essentially flat at plus 0.6%. The pound seems to be taking the brunt of the risk-off sentiment. CIPHER, what is happening with the flow here?
The flow is hostile. Leverage funds have cut their pound exposure by 18,447 contracts week over week. They are now net short 468. That is a complete reversal of sentiment. Previously, there might have been some speculation on Bank of England independence, but now, with the global risk profile crashing to 14/100, sterling is being sold off as a proxy for global growth concerns. The UK economy is sensitive to this kind of fear. When investors get scared, they sell the cyclical currencies. The pound is getting crushed in the cross-asset rotation. Everyone is moving out of commodity-linked and growth-sensitive currencies and into dollar and gold. The shorts are building up precisely because the fear narrative is intact.
Technically, that short building is reflected in the compression. Cable is at 1.34044, which is clustering tightly around the median of its 5-day range of 1.33425 to 1.34519. It is not breaking down violently yet, but it is not climbing either. It is stagnating. The upper bound is 1.34519. If we don't see a volume spike to break that, the path of least resistance is lower. Given the heavy short positioning CIPHER just highlighted, any minor positive news could spark a squeeze upward, but absent that, the default trajectory is a drift toward 1.33425. The market is waiting for a catalyst to decide if the bottom is in or if it's just pausing before dropping further.
And that waiting is dangerous. The pound is highly sensitive to global risk sentiment. When the fear and greed index drops to 14, it means retail and institutional investors alike are panicking. In a panic, correlations converge. Everything sells except the safe havens. So pound doesn't just fall because of UK-specific data. It falls because it is negatively correlated to the VIX. With the VIX at 17.16 and rising, the risk of a sudden, sharp drop in pound is non-trivial. You are holding a currency that is statistically likely to underperform in this environment. The short positioning isn't just a bet, it's a reflection of survival instinct.
Let's talk about the big mover, gold. Gold is at 4,032.55, down 0.51%. It pulled back from 4,062.25. Pulse, you mentioned geopolitical shock. Why is gold retreating if the US-Iran conflict is escalating?
Because gold is caught in a tug-of-war. On one hand, the conflict is driving safe haven demand. That's why it's up on the day overall relative to the broader risk-off mood. On the other hand, the US dollar is strengthening. Remember, DXY has bullish COT positioning of plus 4,438 contracts. When the dollar gets strong, gold, which is priced in dollars, gets pressured. Also, recall that gold is trading at 4,032.55. That is well above the 5-day low of 3,983.56. Traders are taking profits into the geopolitical noise. The initial spike to 4,062.25 was a reaction to the news. Now, the market is digesting it. The cooler U.S. inflation headline also helps the dollar, creating a countercurrent to the war narrative. So, gold is consolidating its gains. It hasn't crashed. It has simply paused as the dollar flexes its muscles.
And that pause looks like a double top formation on the shorter time frames. Rejection at 4,062.25, then a retreat to 4,032.55. If 4,032 holds, we might see a relief bounce back toward 4,050, but the momentum is clearly bearish short-term. The 5-day high was 4,134.98. We are far below that. The distance between the current price and the 5-day low is only about 49 points. That is very tight. We are compressing again. If 4,032 breaks, we are heading straight for 3,983.56. The volatility is contracting, which usually leads to an explosive move, but for now, the bears are in control of the intraday structure.
I'd add that the VIX reading of 17.16 is misleadingly low for gold. Usually when VIX spikes, gold spikes harder. Here, gold is falling slightly while VIX is rising. That divergence suggests that the safe haven bid is exhausted. Investors are worried about liquidity, not just direction. If the VIX pushes toward 18.91, we could see a flash crash in gold as margin calls force liquidations across the board. Don't assume gold will save you if equities crash. In a true liquidity crisis, everything sells initially. The fact that gold is weakening alongside equities is a warning sign, not a reassurance.
Finally, let's look at dollar yen. It's at 162.14, down slightly 0.3%. Grid, you've been highlighting the resistance at 162.488. CIPHER, you've been highlighting the massive yen long buildup. Is this a topping pattern?
It is approaching a technical ceiling. Dollar yen is at 162.143, with the 5-day high at 162.488. That is only 34.5 pips of upside space. In the current low-volume environment, breaking that requires significant momentum. We haven't seen that momentum. Instead, we are chipping away at the highs. If we fail to break 162.488 with a strong close, it will form a bearish divergence against the general dollar strength we see elsewhere. The structure suggests that every touch of 162.5 is met with sellers. I am watching for a break below 161.2825. That is the 5-day low. If we lose that, the entire bullish structure for the week collapses.
And the positioning makes that collapse increasingly probable. Plus 91,779 contracts in yen longs. That is a mountain of risk. If dollar yen stalls at 162.488, those long holders start losing money on carry costs and unrealized losses. They will start closing positions. That closing creates selling pressure, which drives the price down, which triggers stop losses, which drives the price down further. It is a classic short squeeze dynamic, but in reverse. The squeeze here is against the bulls. The data shows that smart money is exiting the trend. They are piling into yen longs precisely because they see the top. The market is lagging, but the tape is turning.
And if the VIX breaks 18.91, that tape turns overnight. I cannot stress this enough. The VIX is at 17.16. The ceiling is 18.91. We are 1.75 points away from a regime shift. If that happens, dollar yen doesn't drift to 160. It gaps. The liquidity is too thin to absorb a sudden shift in sentiment. The 91,000 contracts of yen longs will try to exit at once. The spread widens, slippage occurs, and you get a catastrophic move lower. This is not a maybe. This is a risk management imperative. Reduce exposure to crowded longs in dollar yen immediately. The reward is capped at 34 pips to the high, but the risk is a freefall to the lows.
Let's synthesize this. Pulse identified the macro driver, ECB hawkishness versus Fed stagnation, creating a sticky inflation environment that supports dollar yields but doesn't fully ignite euro. Grid mapped the technical reality. Euro dollar, cable and dollar yen are all at the upper or mid-limits of their 5-day ranges, showing exhaustion rather than breakthrough. Specifically, the rejection of 1.14624 in euro and 4,062.25 in gold is telling us that rallies are being sold. CIPHER provided the flow evidence. Massive yen long accumulation, plus 91k contracts, and pound shorting, minus 18k contracts, indicate that smart money is positioning for a downturn in risk assets and a potential dollar-yen correction. SPECTER warned us that the VIX at 17.16 is nearing its 18.91 ceiling, meaning this consolidation is fragile and prone to violent unwinding. The consensus view is clear: the market is overextended. The euro is capped by fear. The pound is crushed by risk-off flows. The yen longs are crowding the door. And gold is stalling as the dollar asserts dominance. The primary trade for the London session is not chasing breakouts, but managing risk around these congested levels. Watch for breakdown below 1.137.
That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the New York pre-market, where we will see how these calls play out. Until then, trade safe.